Great, thanks, Tom. Jeff Tjornehoj. I'll be talking about bond funds. Um, let's get started here with a look at what everybody did this quarter. Um, um, as you can see, everything looked pretty good. Um, Everybody won. It was kind of hard to describe a quarter in which everybody does well as having a particular theme in it, other than the bonds were in play. Not a particularly strong safety flight necessarily. Tom touched on the sectarian violence in Iraq, the saber rattling between Ukraine and Russia. Normally, those events would draw a lot of people into treasuries and sort of suck the life out of some of the lower credits, but we didn't get that this month. Bonds continued to be a great source of performance no matter where you looked this quarter, and there were very few exceptions to that. So I'm going to roll through a lot of this. It's going to look like and sound like a very cheery view of bonds, and that's true for first quarter as well as second quarter. We're just rolling along. My outlook might change, though. So let's take a look at the first group, talk about inflation-protected bond funds and general U.S. Treasury funds, which are the high-duration Treasury products. Here's what happened to the yield curve over the quarter. The dark red line is at the end of June. So as you can see, we got a flatter yield curve. For the most part, things were fairly quiet along most tenors over the quarter. We saw rates generally, wind their way lower until the end of May, and they started to creep back up until about mid-June. Again, this is going back to some of the news that Tom talked about. And then the last half of June, yields started to come back down a bit. But overall, looking from point to point, pretty flat change in the yield curve. Just a little bit of flattening, not a whole lot of volatility involved, though. And I wanted to talk about TIPS funds as well. This is from St. Louis Federal Reserve. They got that great Fred database. The 10-year break-even rate on TIPS started to creep up, as I said, in the second quarter. And that was good for TIPS funds. They had struggled a little bit over the last couple of quarters. This quarter, they were up about 3.2% as that break-even rate starts to get, creeping up a little bit higher. I think by the end of the quarter, it was a little closer to 2.3%. Can't quite see it on this graph. And that's not a bad place for these products. Again, as Tom talked about, we saw some little signs of inflation here and there over the quarter. For the most part, with the U.S. economy generally facing some mixed results that tended to bode well for Treasury products. I think the biggest news of the quarter on the economic side was the Q1 GDP was revised lower from a -1% to nearly -3%, which kind of shocked people a little bit. I think we understood that the harsh winter was going to contribute to slower economic growth. I think the speed of that surprised a lot. What's important on this reading, though, is that a lot of the inflationary points were spread over. There was a lot more diffusion in the data. It wasn't just some of the core, but it was in some of the X-core groups as well. So that I think struck people as a little odd on this reading. On the other side, a little bit of headwind potentially for bonds is consumer confidence is up. Initial jobless claims fell, as Tom pointed out. Non-farm payrolls were up. I mean, almost touching 300,000, which we haven't seen in a long time. So there's what I would describe as a bit of a Goldilocks economy right now. Not too hot, not too cold. Definitely supportive of being in TIPS for the quarter. Unfortunately, not too many investors enjoyed that nice jump in TIPS. They continued to see outflows for the quarter. Not too many people excited about inflation these days, but it might start to poke its head. Oops, going the wrong direction here. Let's take a look now at corporate debt funds. We're going to look at the A, triple B, high yield, and loan events for the quarter. And I wanted to talk about CovLite, the Covenant Light loans out there. When a company takes out a loan, there are covenants and conditions around its performance such that there's certain restrictions on the amount of debt it can incur. It's got to maintain interest coverage ratios and the like. Well, as borrowers have been in the driver's seat the last couple of years, as more money and more money keeps flooding into leveraged loan products, that really takes the power away from the creditor. And here's the JP Morgan Leveraged Loan Index, and this is the percent of covenant light loans, meaning those loans with less than standard covenant protection for borrowers, and it's just skyrocketing over the last year and a half. So to me, this looks like the market's starting to get a little frothy. We haven't seen default rates jump too high. They're still in line with long-term averages, maybe a little bit lower. So there are certain, I think, moments out there where you start to wonder if the loan market is getting a little too much fervor around it. And I think we're at that point right now. We're starting to see more loans pricing at par, slightly more. Again, that's putting all the power in the hands of the borrower. As an investor, I'd be a little. Oh well, I'm as an investor, I am skeptical about the fortunes for the loan market in the quarter ahead. I'll talk more about that at the end when I wrap up with the outlook. But to turn our attention back to the high yield, the A and the triple B rated products out there, triple B outperformed this quarter. They had the best return of these three. They were up about 2.94%. A rated not too far behind at about 2.5%, and then high yield was actually dragging a bit, coming in at about 2.1%. I think people are skeptical about high yield after last year's stellar performance. Could they do it again this year? You know, for the past year, they're up over 10.6%, and that's twice as good almost as the A-rated. So now's probably the time for people to start looking a little more conservatively. You can see that as their performance. As their choice in corporate debt, at least from the market's point of view, has shifted from high yield into triple B, and maybe they're just starting to feather the nest a little bit before interest rates start to creep up, and there's a greater preference for stronger credits around the corner. Here's some high yield spreads in context. We've got the high yield master option adjusted spread here. As you can see, it is getting darn close to that one standard deviation below the long-term mean area. It's only poked through a couple of times, but when it did, boy, things changed rapidly afterwards. So as you can see, last time we saw this was in 2007 on the eve of the financial meltdown. I certainly don't think we're going to find a financial meltdown around the corner, but I could see people starting to appreciate higher credits and get a little more conservative. Again, probably has something to do with interest rates starting to turn around at an inflection point. But this is where high yield spreads are. So I suppose if you're a real high yield bull, you could claim that they have further to tighten. But boy, we're getting pretty close here. So I wouldn't expect a whole lot of outperformance from high yield in the next coming couple quarters. Next group to take a look at is in our world income group, emerging market hard currency and local currency. We've talked about this a few times in the past, where investors definitely have had a preference for the hard currency over the past year. Emerging market hard currency for the quarter was up about 4.7%. That was pretty good. That was a good 70 basis points better than the local currency debt, which is up about 4 flat. Over the last year, though, hard currency has definitely outperformed, up nearly 9% versus about 3.5% for local currency. So at this point, investors are still preferring the hard currency types, as we hear sort of tough news from Brazil and some of the what we're calling fragile 5 currencies that these days, which includes Brazil, Indonesia, a few others. So something to keep an eye out right now, although I think as preferences change, we could see local currency begin to dominate the hard currency type. Last group to take a look at is muni debt funds. They had a fantastic quarter. They had a fantastic first quarter as well. High yield debt was one of the best performers in the fixed income universe, up about 3.8%. California Muni was also definitely in play. They were up about 3.1%. We saw the biggest news for the quarter in the Muni side was Puerto Rico's legislature trying to buy time for its debt. They're maneuvering to allow what's essentially a restructuring of their debt, and this has prompted the yields in the belly of the Puerto Rico yield curve to jump up a little bit. It's the darker line here. End of last quarter is the lighter line. So while the rest of the market, like the AAA general obligation muni market, saw yields fall and get flatter over the quarter, hard to say exactly if this was flatter or not. I suppose it was a little bit, well, got a strange frown here on Puerto Rico debt. So the belly of the curve, the stuff due between, say, 2021 and 2031, 2035, saw yields creep up a bit over the quarter. Again, investors are having a hard time getting a handle on what Puerto Rico is going to do to shore up its very, very fragile fiscal situation. So it probably will we'll have not heard the end of the Puerto Rico story for quite some time. It's still a work in progress down there. And then final the slide to look at is my outlook, and I thought I'd compare what I said last quarter and give you kind of a scorecard. I expected Treasury yields to stay range bound at the end of the quarter. Yeah, probably not a very bold call. They tended to trend down a little bit overall from point to point. There wasn't a whole lot of volatility in between. In the quarter ahead, I expect Treasury yields to creep up, and I think we'll see a steeper curve at the end of the second quarter. At the end of last quarter, I thought that corporate spreads would tighten a bit more. They did that. I don't think they're going to tighten a whole lot more over the quarter ahead. Again, looking at high yield spreads, we're starting to get into some dicey territory as far as historical means and even exceptionally low spreads right now. I expected last quarter that loan returns would slow because the market was already looking a little overheated back then. That didn't happen. Loan funds returned 96 basis points this quarter. They returned 100 basis points in Q1. So to the rest of the loan market, nothing happened over the quarter that would draw their attention away. I think at some point investors will start to, well, they've already started to pull money out. That happened in June. I think that might accelerate as they can find better returns elsewhere. And I think advisors are starting to notice that the loan market is looking a bit frothy, and probably that outperformance might be hard to find. Again, defaults are still relatively low, but as you tend to put all the power in the hands of the borrower, things will start to unravel at a point, and I think that point will show up this year. And I can't say when exactly, but I do expect in the third quarter that loan returns are going to slow down more than 4 basis points. That's nothing, but maybe even like 20, 30 basis points lower. Emerging market hard currency I thought would outpace local. Probably not a tough call. But I think in the quarter ahead, we're going to see investor sentiment turn towards the local currencies. I think the fragile five are starting to look a little bit better. The Brazilian real kind of stopped its fall against the U.S. dollar this quarter. A lot of that's going to be some of that World Cup fever, a lot of money being spent down in Brazil. I think it's going to take more than just a month or a few weeks for that ripple effect to be fully felt. I think Brazil is going to enjoy a nice bump out of the World Cup. And then the last one here, munis, I thought they'd do relatively well. They did do relatively well. I think they're going to have a really tough time duplicating that effort in the quarter ahead. We've started to see retail investors pull money from munis. I think a lot of that has to do with what's going on in Puerto Rico. There's going to be some knock-on effects throughout the rest of the industry, as we know that there are a lot of funds out there with heavy exposure to Puerto Rican debt. Again, I think advisors are starting to put the brakes on that, wanting to protect their investors, because there really doesn't seem to be a good ending for Puerto Rico. All the analysis I've read suggests that we're going to see some haircuts at some point, and it's not going to look pretty. So with that, I will pass the baton off to Barry Fennell.